Good afternoon, everyone. I'm Christina Medland. I'm one of Meridian's managing partners. I wanted to offer a warm welcome to all of you and thank you very much for joining us. I expect this will be a very interesting hour talking through the SEC's very recently released pay and performance disclosure rules. We have two Meridian speakers leading our discussion today. We'll start with Dawn Kalfen. Dawn is the leader of Meridian's regulatory and governance group and a longstanding Meridian partner. Dawn will be followed by George Paulin, a Meridian partner with many years of executive compensation consulting experience. I'll now hand this over to Dawn and we'll get started.
Thank you, Chris, and welcome everyone. We have a very full agenda here and we'll try to go through it as expeditiously as possible. First, in terms of today's agenda, we'll be covering three items. We'll do a complete technical overview of the final rule issued by the SEC. In addition, we're going to suggest implementation steps for your consideration. And lastly, future design implications. With respect to submission of questions on the presentation or to request the presentation deck, please email Jody Herzberg at jherzberg@meridiancp.com. We'll show Jody's email again at the conclusion of this presentation. So how do we get here? The genesis of the pay versus performance rule goes back quite a few years, actually before the Great Recession, to the credit crunch that occurred in 2007, led to the Great Recession 08-09, which itself led to the enactment of Dodd-Frank in 2010. Dodd-Frank ostensibly it was put in place to regulate financial institutions, but it also included a chock full of governance provisions related in large part to executive compensation. In 2010, the SEC issued proposed rules, and finally, 7 years later, the SEC adopts the final rule, and that was last month. Specifically, Dodd-Frank directed the Securities and Exchange Commission to write rules that will require public companies to disclose in their annual meeting proxies a clear description of the relationship between executive compensation actually paid and the financial performance of the issuer, taking into account any change in the value of the shares of stock and dividends of the issuer and any distributions. So that directive led to the SEC's rulemaking, and the rulemaking is complex and lengthy. A couple of basic provisions to bear in mind. The effective date for the new disclosure is for fiscal years ending on or after December 16th, 2022, which means all calendar year companies will have to have this disclosure in place in their 2023 proxy. The companies covered by the pay versus performance disclosure is virtually all public companies, with some minor exceptions. Foreign private issuers, registered investment companies, and emerging growth companies. Executives who will be part of the pay versus performance disclosure are all named executive officers, including those proxy disclosed NEOs who separated during the reporting year. With respect to the location of this new disclosure, it's included in the annual meeting proxy, but at a location chosen by each company. So companies are free to include it in their CD&A or outside their CD&A. George will provide a little more color around issues as to where placement may be most ideal. And lastly, the period covered by this new disclosure. It's 5 years for all public companies subject to the new rule, except for smaller reporting companies, they're subject to a 3-year period. However, the 5-year period is subject to a phase-in, and in the initial year, in the 2023 proxy, that will cover 3 years. The 2024 proxy will cover 4 years. And lastly, the 2025 proxy will cover 5 years. The table that you see on this slide is the heart of the pay versus performance disclosure, what I'll refer to as the PVP table. The intent of this table is to clearly show the relationship between compensation actually paid to NEOs and each of the following company performance measures: cumulative total shareholder return, net income, and a company selected financial performance measure. The PVP table may be presented in one of the following formats: in a single table, as you see before you now, in two tables, one for the CEO and another for all other NEOs, or in multiple tables, separate tables for the CEO and each other NEO. If it's presented as a single table or two tables, the compensation of the other NEOs besides CEO will be average compensation in the two columns that you see above. That will appear in the formats where there's a single table and two tables. Now look behind the curtain as to what each of these columns mean and how they will be populated. Take a few moments to discuss that. Starting in the far left column, year, we'll start from the most recent fiscal year on down. So in the first proxy, 2023, that reports the PVP table, year one will be 2023, year two will be 2022, year one will be 2022 fiscal year two will be 2021 fiscal year, and year three will be 2020 fiscal year. With respect to the CEO in the next column, what will be reported is the CEO's total compensation as disclosed in the summary compensation table. Similarly, for the other NEOs, total compensation will also be derived from the summary comp table, but averaged for all the other NEOs if a single or double table is used. Compensation actually paid to CEO or to other NEOs is where the hard part comes in this disclosure. Compensation actually paid is a modification to total pay for the executive officers. So as I'll describe later, you'll start with total pay, and then there are adjustments made to change in pension value, if applicable, and values for stock awards. Moving further to the right, there's two columns regarding TSR. The first cumulative TSR column relates to the company's TSR, and the next cumulative TSR relates to peer group. Now, in both cases, TSR is measured based on an assumed investment of $100 at the beginning of the measurement period. More on this later. With respect to the peer group cumulative TSR, companies have a choice. They may either use the proxy disclosed peer group that is used for benchmarking executive compensation, or the peer group used in the performance graph, which is disclosed in Form 10K. Another wrinkle in the calculation of TSR is that cumulative peer group TSR is determined on a market capitalization basis. Next, net income. This, of course, is derived from the audited financial statements of covered companies. And lastly, the last measure is a company selected performance measure. And it must be the most important GAAP or non-GAAP financial measure that links actual pay to company performance. More on this as well. An important aspect of the pay versus performance table is the identification of the NEOs and the disclosure of the NEOs. So each fiscal year covered by the P versus P table, a separate determination is made as to who the proxy disclosed NEOs are, and they'll come right from the summary comp table. And that is fixed for that fiscal year, irrespective of any change in the composition of NEOs in future years. For example, a previously disclosed NEO who no longer is an NEO in future covered fiscal years, The former NAO will not be included in the calculations for those covered fiscal years. There's calculations for the actual compensation paid, nor will that NAO's total pay under the summary comp table be used in calculating average total pay for all the other NAOs. However, previous disclosure of the former NAO's pay will remain in the PVP table. As I previously mentioned, the NAOs are fixed each year, and their pay, which is used to calculate actual compensation paid or average compensation, remains fixed. It does not change in the table. In addition, each NAO included in the calculation of average actual compensation paid to other NAOs must be disclosed by footnote for each fiscal year included in the PVP table. So this could result in extensive footnote disclosure, especially because the three highest paid executive officers, other than CEO and CFO, are often subject to change on a year-over-year basis. Lastly, if multiple CEOs are employed during a fiscal year, separate columns should be added to the PVP table to show each CEO's summary compensation total pay and compensation actually paid. The final rule also requires extensive footnotes to the PVP table. These footnotes include the following. The amounts that are deducted from or added to SCT total compensation to arrive at compensation actually paid must be disclosed by footnote. The valuation assumptions used in determining any equity award adjustments that are materially different from those as of the grant date of such equity awards must also be disclosed by footnote. The identity of companies composing the peer group, unless the peer group is a published industry or line of business index. And lastly, any changes in the peer group, the reasons for the change, and a comparison of the company's cumulative TSR with respect to both the newly selected peer group and the peer group used in the immediately preceding fiscal year. What is uncertain is what constitutes a change in peer group. Is it a wholesale change where a company is completely replacing its peer group, which rarely happens? Or is it a change in one or two companies, which does typically happen year to year? The final rules do not clarify that point. Now, on this slide, this presents the complexity of the PVP table. And it will require significant resources and efforts by public companies to comply with these requirements. So as mentioned earlier, to determine compensation actually paid each executive officer, total compensation is reported in the SCT must be modified. And that's what this chart shows, the modifications. So one starts with total pay and then subtracts out change in pension value as reported in the summary compensation table and all equity values, both stock award values and option values that are reported in the summary comp table. Those are subtracted. Then added back is pension value attributable to current year's service and any change in pension value attributable plan amendments made in the current year. This number in most cases will likely be less than the change in pension value year over year. Next, added back to summary compensation total pay is the fair value of equity compensation granted in the current year, but valued at year end. So to be clear, the grant date fair value of such awards are subtracted from total pay, and then the fair value of those same awards are added back, but valued at year end. Also added back to summary compensation total pay is dividends paid on unvested shares or share units and on stock options. This is a fairly rare phenomenon, particularly with regard to stock options. There are still some companies that pay dividends on a current basis. In that case, those dividends must be added back to total pay. And then the next three reflect the mark to fair value accounting that is in the final rule. So awards made in prior fiscal years, for example, in 2022, they were unvested at the end of the current fiscal year, let's make that 2021 and remain unvested in 2022. You would add or subtract the change in fair value from the end of the prior fiscal year, 2021, to the end of the current fiscal year, 2022. That number, of course, can be a negative number, especially if share price declines. That would be the expected outcome. In addition, awards made in prior fiscal years, so this could cover multiple years, that vested during the current fiscal year, company would add or subtract the change in fair value from the end of the prior fiscal year to the vesting date. And once the vesting date occurs, there's no more accounting or disclosure with respect to that award or awards. Lastly, awards made in prior fiscal years that were forfeited during the current fiscal year are subtracted from total pay based on the fair value of the forfeited awards determined at the end of the prior year. So for example, a PSU granted in 2021 that was forfeited in 2022, the amount subtracted from total pay is the fair value of those PSUs at the end of 2021. And once you finish with the additions and subtractions as set forth in this table, that will equal the compensation actually paid to each NEO. The upshot of all of this is that companies are going to have to make many calculations to determine compensation actually paid. And these calculations are based on GAAP, in particular ASC topic 718. Essentially, awards must be marked to fair value until vested or forfeited. And I give you an example here to show you the number of calculations that must be performed with respect to a single award. Assuming a stock option is awarded on March 1st, 2022 with 3-year cliff vesting, this will require 5 separate Black-Scholes calculations as the dates specified below. First, there's the grant date fair value calculation for disclosure in the summary comp table. Next is the end of the year calculation in the year of grant. That's December 31st, 2022. Then in December 31st, 2023, you must determine the change in value of that award between 2022 and 2023. They'll require another Black-Scholes calculation at the end of December 31st, 2023. And then again, at the end of 2024, same calculation must be performed to determine the change in value, fair value between 2023 and 2024. And finally, on March 1st, 2025, the award is vested and will no longer be included in future PVP tables. And determine the mark to fair value amount for 2025, it will be the difference in fair value at the end of December 31st, 2024, and the fair value on March 1, 2025. So this is a longitudinal look, but in any given fiscal year, there'll be multiple awards that flow through that fiscal year. They'll also require calculations. So for those companies that have grants of stock options, market condition-based awards such as PSU subject to a TSR and time-based restricted stock units, there'll be multiple calculations, both in the Black-Scholes and Monte Carlo simulations, they'll be required in a given fiscal year. With respect to mid-cycle performance awards, subject to a performance condition such as financial metrics, each year until the award is vested will require management to estimate the number of awards probable to vest at the conclusion of the performance period on each valuation date. So if you have a PSU granted in 2020, and for each year thereafter, management has to determine what's a probable outcome and attach a value to that probable outcome. So if 50% of a PSU is expected to vest, and that equates to 100,000 units, then that 100,000 will be multiplied by the share price at year end to come up with the then current fair value. And this will be used to determine change in fair value. If the PSU is subject to a market condition such as TSR, this will require Monte Carlo simulation or other mathematical model to determine the fair value of the award at the end of each year. Next, moving the disclosure of cumulative TSR for company and peer group. The length of the TSR measurement period starts at 3 years for the most recent fiscal year and declines by 1 year for each prior fiscal year. This is per the phase-in period. Of course, once companies are 2 years out, the TSR measurement period will expand to 5 years and then decline 4, 3, 2, and 1 year for each preceding fiscal year. As I mentioned earlier, TSR is disclosed as an increase or decrease in the investment of $100 in company stock and stock of each peer group company. As mentioned earlier, the wrinkle in calculating peer group TSR, it must be weighted in accordance with each company's market capitalization value at the beginning of each measurement period. Below, there's a table that shows how this will be presented. So in this table, we're assuming hypothetical increase of 7% in company TSR for each year disclosed below, and an annual increase of 5% in peer group TSR. And that will result in the disclosure you see in that table. The measurement period for 2020 is 3 years, starting from December 31st, 2019 through the end of 2022, and that declines to 2 years and 1 year. And this demonstrates how the disclosure will be made in dollars rather than percentage change. The closing price on the last trading of 2019 will be very influential because it will affect cumulative TSR and peer group cumulative TSR for this entire measurement period. Next, companies are going to be required to identify a specific performance measure to include in the PVP table. In order to select a performance measure, it must meet specific requirements. In particular, in the company's assessment, the performance measure represents the most important financial performance measure used to link compensation actually paid to its NAOs to company performance for the most recently completed fiscal year. So the financial metrics cannot be forward-looking. They have to be metrics that affected pay in the current fiscal year. The performance measure may be a non-GAAP financial measure, such as EBITDA. However, in that case, there must be a disclosure as to how the non-GAAP measure is calculated from the company's audited financial statements. A financial performance measure under the final rule is any GAAP measure, any measure derived wholly or in part from a GAAP measure, stock price, or total shareholder return. A company may change the company selected performance measure in future years if appropriate. For example, a company may initially use revenue as its most important financial performance measure and report revenue outcomes for each of the disclosed fiscal years. And then in a future fiscal year, it determines EBITDA, its most important financial measure. So EBITDA will replace revenue for all reporting fiscal years, not just the fiscal year that the decision is made that EBITDA is most important for all disclosed fiscal years. Additional disclosures are required following the PVP table. Companies are required to make a clear description of the relationship between pay versus performance and a comparison of cumulative TSR and peer group TSR. Specifically, a company must describe the relationship between compensation actually paid its executive officers and the following metrics across all reported fiscal years: the company's cumulative TSR, the company's net income, and the company's selected financial performance measure. The final rule does not provide how extensive or how detailed this disclosure needs to be. I think the first few years, there'll be a lot of experimentation as to how robust this disclosure should be. In addition, a company must disclose a comparison of cumulative TSR and peer group cumulative TSR across all reported fiscal years. And lastly, the nature of this disclosure may be in any form: narrative, graphical, or a combination of both. In addition to the PVP table related disclosures, the SEC is requiring companies make additional disclosure regarding 3 to 7 financial performance measures. This is apart from everything I've spoken to this point. A company is required to include a tabular disclosure of 3 to 7 financial performance measures that the company determines are its most important measure, used to link compensation actually paid to each NEO and company performance. Companies are permitted, but not required, to include non-financial measures in the list if they consider such measures to be among their 3 to 7 most important measures. If a company has fewer than 3 financial performance measures, then it would disclose such lesser number of performance measures. No ranking of performance measures is required. And lastly, no requirement to show financial data related to the disclosed financial measures. And lastly, companies are permitted to make voluntary supplemental disclosures, not required under the rule, provided that such additional disclosure would not be misleading and would not obscure the required information, and it must be clearly identified as supplemental. The final rule provides the following examples, which we do not believe is intended to be exhaustive, of additional disclosures that may but is not required to be included in a company's proxy statement. Any voluntary pay versus performance disclosure previously included in a company's proxy may generally continue to be included in the proxy in their present format. In addition, long-term performance metrics measured over periods longer than a single fiscal year may be disclosed. And lastly, and perhaps most importantly, additional compensation, performance measures, or additional years of data may be added to the PVP performance table. So this allows companies to add a column or two of other performance measures that they may think are important to demonstrate the relationship between pay versus performance. And if they believe additional years of data helps to further bolster the relationship between pay versus performance. Public companies are free to add to the 5 years, 6 years, 7 years, and the like. It remains to be seen how many companies will take advantage of this, and it remains to be seen how clear these disclosures will ultimately be. But this is an overview of what the final rules provide. And I think for price disclosure in 2023, there remains a lot of unanswered questions that hopefully the SEC will provide guidance in the form of future FAQs. And with that, I'll turn it over to my colleague, George Paulin.
Don, thanks for the overview, and thanks all of you for joining us today. You all listened to the overview, and you're probably all already in maybe looking at this in one of two ways. From the company perspective and the compensation committee's perspective, you might think that this new disclosure is just more accounting value. It's incomprehensible. It doesn't tell you how much compensation was actually paid to an executive. And we ought to put it somewhere behind the CEO pay ratio in small font, because the proxy advisors and the investment funds aren't going to use it in their analyses, and it's not going to affect their say on pay decisions. And that's one way to look at it. The other way is that the proxy advisors and the investment funds want the new disclosure, and they're going to use it to evaluate the long-term directional relationship between pay and performance that they think is important, and that professionally, we all need to work to make this clear, transparent, and on a company by company basis, work to tell the best story. I get both sides. I'm probably more in the second category than the first, but either way, the rules are what they are at this point. And we don't have time to wait to get started for additional clarification. We've got to move forward. There's a lot of work to do fast. So we thought that we'd go through with you some of the implementation steps to consider for the 2023 proxies. Some of you are probably already in the drafting stage, and then after that, some of the implications. On the implementation steps, let's focus more on the left-hand column here of the slide, and I hope many of you will get a copy of the slides so that you can consider the detail. But and some of this is just common sense. But point number one, I won't just read it to you. I think point number one is we need to mobilize the resources to get this done, and it's complicated. There's a lot involved here. It's not just the compensation staff and the advisors and a lawyer, but we need somebody from finance. We need somebody from accounting. We need somebody who understands equity valuation and Black-Scholes values and Monte Carlo values. We need a pension actuary, and I think we need somebody from investor relations to help us with perspective on how the shareholders and the proxy advisors are likely to look at the story we're telling, from one company to the next. And so we got to get that team together and do it now. Number two, we don't really know what these numbers, are going to look like. We got to have some sense of it, but we need to do some modeling, and we need to use that modeling, I think, to inform a couple of decisions that are going to have to be made for the 2023 proxy. One is the peer group. Do we use the benchmarking peer group from the CDNA, or do we use the broader performance graph peer group from the 10K? And we're going to select a measure that's different from TSR, that's different from net income, to go next to those. That's our sort of primary measure, and we need to do some modeling to look at what the numbers are for 20 and 21, and we know those numbers, and it's late in the year, late enough to do a projection for 2022. So we can look at the 3 years that are going to be in the first proxy based on for 2022 where we're tracking and the accruals. And I think that we should do the modeling for both peer groups, and we should do the modeling for the likely categories or measures that would be that select company performance measure. And if it looks like the select company performance measure is not the primary measure that's being used for determining long-term performance awards, we got to be prepared to write the narrative around that, because I think that the proxy advisors and the investment funds are going to expect that company selected measure to be the primary measure in the long-term award plan. And in doing all of this, we should recognize that at least if you look through the 243 pages of the of the reg, that it looks like after-tax income and the company selected performance measure are in there, because the SEC was being careful to avoid over-reliance on just TSRs that concerned a lot of companies that responded in the comment period, and also the investment funds. Don, I think you're controlling the slides here, so maybe you could go to the next page. 4 more implementation steps. The third is you got to decide if you still need supplemental disclosure. I say still. Some of you have it. Compensation actually paid, that's what it's called in the new rule, is not compensation actually paid. So you may want a supplemental disclosure to tell a story that you think is incomplete or inaccurate. And you may want to expand the tabular data in the required disclosure to enhance the messaging. TSR percentile ranking, year-over-year change in pay and performance, that type of thing, since we think there'll be a directional focus. The fourth is the identification of these additional 3 to 7 measures. Again, this one I think is common sense. I think that we think that companies should be informed by looking at what measures are being used by their peers, or at least their most direct peers. What obviously is considered in the program as it currently exists. You want to consider the complexity of all of this. You're allowed to do one list for everybody. You could do one list for the CEO and another list for the other NEOs, or you can do it by individual. There's a lot of complexity here, and the complexity expands, with multiple lists. You got to decide where to put this. We think, at least preliminarily, that it's more likely that companies will put it in the CDNA, where the information in the disclosure was actually used in making pay decisions, and it'll facilitate, an understanding of the program. It's more likely going to go outside the CDNA, if you're in that first category that I described. But beyond that, if you want to include in the CDNA voluntary disclosure or supplemental disclosure of your own view of real earned compensation, realized pay and realizable pay that's different than what's in the disclosure. So you don't have a conflict, and then the new table will be someplace else, and just this is required disclosure. It is what it is. And remember that if it's in the CDNA, the comp committee approves including the CDNA and the proxy. So you're giving them de facto sign off on what's in the disclosure, which may be a good thing. And then finally, again, this is another common sense one. Get this started now and get the compensation committee involved. I think that you're going to want their input, and you're going to want to avoid surprises. And the input is going to be important on the choice of the peer group, the company selected performance measure, and what is what are the most important measures, and where you're going to put this in the proxy. So those are what we would see as the current focus. Don, if you go to the next slide. This one, well, let me preface my remarks here. We're talking about design implications, and please, everybody who is listening in, let us be clear that Meridian isn't saying redesign your compensation program around this new disclosure. What we're saying is that the professional community needs to know where and how design may be impacted by this disclosure, and consider that impact. And some of the design areas, and by the way, this isn't necessarily all on the table before the 2023 proxy. I think the 2023 proxy is kind of baked, if you will, at this point. And the decisions there and the choices are, pretty clear. Going forward, when we consider, the story we're telling and what levers we have to influence that, some of the things that we're going to want to consider are, peer group selection and the continuity of the peer group. And I think that peer group selection is influenced maybe in two ways. Number one, we're going to want to look at the historical relationship between the total shareholder return of the peers and our total shareholder return. And number two, if we're using a small group of companies, we're going to want to look carefully at market cap outliers, especially on the high end, because the rule is a market cap weighted peer group. So you don't want one company skewing the results. That could be an unintended consequence here. And also, just thinking of the sort of technical end of this, volatility generally is higher in smaller individually selected company peer groups. That's going to flow through to the reported annual accounting change. So, we got to think through all of that. Another area, obviously, is financial performance metric selection. And on the company selected measure, it's got to be one that is your primary measure for linking pay to financial performance, and you're going to have to test the correlation of that with total shareholder return. And I'm not talking about the correlation of pay. I'm talking about the correlation of performance. We don't think that the proxy advisors are likely to change their methodology on, the quantitative pay for performance analyses, but they're going to be looking at this. And just a sort of caveat warning, the complexity of changing the company selected measure is not something to overlook. And using different measures for different NEOs is also very complex. So both of those actions are, likely to be discouraged. The third design area, I mean, look, you just look objectively at this, and you're likely to conclude that options are advantaged here from a disclosure standpoint in this new table versus other forms of long-term incentive. The grants come out when they vest. So, you got options in there. There's the intrinsic value of the option profits at the time of exercise is not in the tables. That's not compensation actually paid, as compensation actually paid is being defined here. That's in another table. So you gotta put that together. But both options and market-based long-term performance awards, and generally the market-based measure is relative total shareholder return, and everything has absolute total shareholder return because you grant at the beginning price and you pay at the ending price. Options and market-based long-term performance awards kind of stick out as being advantaged in this disclosure relative to the other forms. Don, if you go to the last page here, 4 other things. Option vesting, all else equal, you'd be encouraged to have a shorter option vesting period than a longer one, because once the options are vested, they're out of the table. And that's not to suggest that we ought to game this thing, but that's how the rules work. Equity valuation, it is complicated. Black-Scholes, Monte Carlo values. This may be an opportunity to look at the methodology that you're using and to confirm that it is what you want it to be in terms of how you're weighting historical and expected volatility, the frequency of the volatility inputs. Are you using daily inputs or weekly or monthly? And how are you, what's the basis for your assumed option exercise experience? And is it linear in out years? If you start out with 6 years, is it 5 if you subtract 1 and 4 if you subtract 2, or does the math change? We need to think that through, and that ought to be after the 23 proxy. If we think that a major focus of the proxy advisors and the investors is going to be on directional pay versus directional performance, it's going to have an impact on the slope of your financial performance curves, and especially the target to maximum slope, so that you get a better sense of how this is going to be impacted. Should you have a flatter line to avoid a higher payout in a lower year, vice versa, that type of thing. And that's something that we're going to have to think through. I think there's going to be an impact here on one-time special awards and front-loaded awards. Companies are going to be less likely to do this in low performance years, maybe when they need those kinds of special grants and front loads the most to support recovery goals and retention, which I don't see as a good thing. And this is further discouraged by, the year-over-year accounting change, because you're going to have one, kind of huge award in there that's impacting things. And then finally, making adjustments or modifications to in-flight awards. And the point being that those adjustments and modifications will go into the year-over-year accounting change unless they're specifically excluded through pre-established non-discretionary or at least improbable exclusion language. So this is just some of kind of what we're going to be looking at here in the future as a as a preview. So let me close this out. Again, thank you all for your participation. We hope that you review this material carefully, get back to us with questions and comments. And Don, if you go to the last slide, the last slide here, just wrap up again with Jody Herzberg's email, and she's looking forward to hearing from everybody to get a copy of the material and to ask any questions and to make comments. So thanks very much for your participation.
Yes, thank you as well. We look forward from hearing from each of you. We'll keep the slide up for a couple minutes. So if you wish to jot down, you'll have time to do so. Thank you.
This is also the same address that you sent your request for the invite to, so you may already have it. Thanks very much to everyone for attending.